Hello everyone, I'm Sam and welcome to the Foxxy Stocks YouTube channel. We're here to help you build wealth and achieve financial freedom by trading options safely and profitably. But what are options? Well, in today's video, myself and my friend Buddy, the options expert, are going to give you a 5-minute overview. If you want to learn more, you can watch our full webinar, which gives you all the information about trading stocks right here. But for now, let's just jump straight into the video.
So you want to tell people what options are?
Absolutely. So if you know anything about stocks, you can buy and sell stocks on the market at their given current price, but options allow you to buy or sell stocks at strike prices, different prices than what the market price is. So basically an option is a contract with another party to either buy or sell shares within a certain time frame at a certain price. Okay, so they allow you to trade in calls and puts, which we'll explain in a little bit, and they come in groups of 100 shares at a time. Okay, so it's important to remember. They have an expiration date which can be short or long. It can be anything from a short period, like less than a week, to all the way out several years. So depending on what that time frame is, it's going to change the value of that option. And if you're somebody on the buying side, you are going to pay a premium to somebody, to this seller on this selling side, and you pay that premium regardless of what happens in the outcome of the contract. Sometimes they expire worthless, sometimes you get to exercise your option and either buy or sell the shares.
Yep, exactly. I think it gets a little bit easier to understand when you start separating between the calls and the puts.
That's right.
You want to tell them about that?
Yeah, so just on the calls side, if you're buying a call, you're basically making a bet that the stock's going to go up. And so you want to call shares to you at a certain price, the strike price, which is above the market value at the time when you make the contract. So if the stock goes up, you can buy those shares at the agreed price, regardless of how high the stock goes. Am I correct on that?
Yeah. Well, you technically don't have to buy something above its current price. It's usually you are, because that's where the best value is. Otherwise, you're paying for the intrinsic and extrinsic value at a higher rate. So to just give an example, let's pretend that you had a stock that you liked. Let's call it Workhorse as our example today. And it's currently trading for $21, but you believe that, in the short future it's going to go to $30. Well, you could buy the $25 call, and then once it's above $25, you're making $1 profit per share. And instead of buying 100 shares for $25 each or $21 each, you might only pay $1 each. So you might pay $100 for that call option. But then you're limited to that time window. And the shorter the time window, the less it'll call. So it's the less it'll cost. Sorry. And which basically you're creating leverage, but you're getting a short fixed amount of time when you do so.
Now, on the opposite side of that, still on the calls, if you're selling a call, you agree in this contract to sell your shares at the strike price, whatever the contract says it is, and you're collecting a premium in the meantime. So you own shares, somebody buys a call, and you will sell them at that price. Now, on the put side, this is a little more interesting. So if you're buying puts, this is where you're basically kind of getting insurance. You're entering a contract with someone that says they will buy your shares off of you if the price drops to the strike price. So this is where the strike price is below. Now, if you're selling puts, this is where it gets really interesting. You will buy the shares off someone when they drop in price. And that's really interesting if you like the stock.
Yep, exactly. And it's when you're starting out, it is confusing to think about what is a call, what is a put. But you think about it from the buyer's perspective. The call, if you're buying a call, you get to call shares away from somebody else. And if you're buying a put, you get to put your shares to somebody else. And so maybe that helps you understand or remember it a bit easier. And when you're on the selling side, you're just the flip from the buyer. So if you always just remember what the buyer side is, you can figure out what the seller side is off of that. So yeah, at foxxystocks.com, the main strategy that I want to focus on and teach is in fact selling puts. But before we get into that, let's talk about some just general myths.
So that was just a 5-minute segment from our full webinar, which teaches you everything you need to know to get started trading options. link below. If you found this video helpful, please give it a like and subscribe for more videos all about investing and building wealth. Thank you for watching. We'll see you in the next one, and happy trading, everyone.